Do you like trading LEAPS options because it reduces how much capital you have at risk, but still gives you the possibility of having a big win? Is that the best option strategy that's similar to owning stock, or is there a better one? For example, what about the Zebra? It's pretty similar to the LEAPS option. Is it better than the LEAPS? Then what about the Zebra's cousin, the ZEEHBS? It gives you some downside protection. Is that better than the LEAPS option? And how do all these compare against owning a stock? Well, I was curious about that, so I did a back test. I'm going to share the results with you in this video. If you don't know what any of these option trading strategies are, no worries, I'm going to explain it all to you. So if you're ready, let's get started. First, let's talk about the stock I picked to do this back test on. And the stock is one that probably all of you know, which is Tesla. During the time frame I tested, you'll see that Tesla had a nice run up in price. Started back here in January 2nd of 2024. We're in it all the way through January of 2025. Now during this time, Tesla gained about 60% in value, or about $145 per share. Just kind of try and keep that in the back of your mind as we go through these different scenarios. First, and real briefly, what is a LEAPS call? Well, here you see a LEAPS call that we did in Tesla. We did it on the same date, January 2nd of 2024. All we simply did is we bought a LEAPS call. All LEAPS call is a long-term call option, or an option that expires over a year into the future. So how do we do that? Well, we bought the January 17th of 2025 call option. We bought the 230 strike price call option. Tesla was trading for around $247 per share. So this option was in the money by about $17 per share. Notice down here in cost, it cost us right at $6,300 to buy this LEAPS call option. So that's a LEAPS call. It's that simple. You buy a long-term call option. You want the stock to go up. So that's a LEAPS. Now second, what is a Zebra? Well, it has a lot of the same characteristics of a LEAPS call or put, but there's a little bit of a different twist to it. See, with a Zebra, you're trying to take out that extrinsic value. One of the problems with a LEAPS call option is that there can be a lot of extrinsic value. And remember, that extrinsic value, it's all gone at option expiration. For example, this option cost us around $63 per share to buy. But with Tesla trading at $247, we bought the 230 strike, which this option only has $17 of intrinsic value. It's only in the money by $17. That means $46 of that $63 we spent per share is extrinsic value. That right there is known as time decay, or theta, or if the stock didn't go anywhere the next year, that would be gone. So what Zebra tries to do is to get rid of that extrinsic value, that time decay eating away at the value of your position. And here's how it does that. Now, you can do it with a put or a call depending on which direction you think the stock should go in. We'll just do it with a call because we're going to say Tesla, we're bullish during this time frame. So how do you create a Zebra? Remember, with a LEAPS, you just buy one call option. But a Zebra involves more legs. So we're buying two in-the-money call options and we're selling one at-the-money call option. And the goal here is to remove all that extrinsic value. Remember those $47 worth in that LEAPS call option we bought? And we're also trying to achieve a positive delta of 100. We're basically trying to create a position that acts like the stock would act if the stock went up in price. And here you see the profit and loss chart of what that position would look like. So you bought two call options that are in the money, you sold one that's at the money. And one nice thing about a Zebra, which is kind of like with LEAPS, so the most you could lose would be what you pay for the position, not how much the stock dropped in price. See, if you own the stock, you could lose a lot more because you're paying for the whole shares. But with a Zebra, you're taking a delta positive position but with a lot less money. And notice what happens as the stock goes up in price. Well, you make money similar to what would happen if you own the stock, because the delta is right at 1. And here you see that Zebra position on day 0. So notice the DIT, days in trade, we're still on January 2nd, and we're starting the Zebra position. Remember, the goal is to get rid of that extrinsic value while having your delta near 100 for the overall position. And here you see the delta is at 98.02. So pretty close to 100. But notice the cost of this position. It costs a lot more than a LEAPS call option. It's $11,952. So you're gonna spend almost twice the amount for this Zebra position, but it does eliminate almost all your extrinsic value. Notice here at theta is really low, as you see here. So that's a LEAPS call and a Zebra. Now let's talk about the Zebra's cousin, which is a ZEEHBS. And I'm probably saying that wrong. I'm sorry if I'm getting it wrong. I'm doing the best I can here. I'm good at math, not really English. So let's see what a ZEEHBS is. Now what a ZEEHBS does, it doesn't just give you the benefits of a Zebra, but it also lets you buy a put option. So if the stock were to go way down in price, well, that put option could actually make money on you beyond a certain point. And here's how it's structured. So remember with a Zebra, we're buying two in-the-money call options, we're selling one at the money. Well, with a ZEEHBS, we're buying four in-the-money call options, and we're selling two at-the-money call options. so kind of twice the size. So you have a lot more contracts you're trading, so your commissions will be higher. But we're selling even more contracts because now we're going to do that little hedge I told you about. And we want to try and do that hedge for free if we can. So in order to do that hedge, we're selling an additional call option. We're selling it kind of against that zebra position. Remember, we did 2 zebras. Remember, the regular zebra was 2 in the money calls, 1 at the money call. But now we're doing 4 in the money calls and 2 at the money call. So basically, we've done 2 zebras. And we're treating one of them like a covered call. We're selling a call option against it. We're using the cash we got from selling that additional call option to buy a put option. And that put option will go up in value if the underlying stock goes way down in price. Just so you can visually see it, here's an example of that using SPY. Here we're looking at a 7 days to expiration option chain. So the SPY was trading for around $597 per share. So we bought 4 of the 592s, that's the call options that are in the money. We sold 2 of the 598 options that are at the money. Then to buy our hedge, we sold 1 more of the 597 calls and used that cash to buy a put option at the same strike price, 597. So this is Zebra with a hedge, and it's called a ZEEHBS. And if I'm getting it wrong, I apologize again because I probably am. So now I have the lingo and the understanding of what these 3 option positions are. And remember, they're competing against Tesla. And I did it over a long time frame because I wanted to see what happened when the stock dropped, but also when the stock went up. So let's see how these 3 different option positions responded to the stock going up and going down to determine which is best. Now, one thing that happened almost right off the bat is 6 days after we entered this trade, notice we're at 6 days in trade, Tesla actually went down in price. So how did our options respond to that? Well, here we have our LEAPS option. Notice that it was down $673. And our Zebra, well, it was down a little more. It was down $861. And our ZEEHBS, the one that had that extra put as protection, it was actually down more. It was down $1,000. Does that kind of make a pop in your head? It's not doing what we were hoping it would do. If the stock went down, we were hoping that put option would go up in price, but it's not going up enough to offset how much we're losing on the call position we're in. So not looking great for ZEEHBS so far. But let's fast forward in time and see how it responded later in the trade. Now we're at 111 days in trade. You see here? 111 days in trade. And notice that Tesla has experienced a really sharp drop. It's down to $141 per share. This really kind of gives us a nice stress test of how these positions handle a big downturn. So here we have our LEAPS option. Notice that it's down $5,721. So it's lost a tremendous amount of value. It's lost 90% of its value. What about the Zebra? How did it fare in this big price drop? Well, notice that it's lost $9,909, so 83% of its value. So dollar-wise, ouch, we're kind of hurting, aren't we? All right, what about our one that has that hedge in there? The ZEEHBS, isn't that how you say it? ZEEHBS? Let's see how that responded. All right, here's our ZEEHBS. So our ZEEHBS is down $8,476, or only 37%. So that hedge, it actually has helped us because it's not down nearly as much percentage-wise as the other 2 positions. But although percentage-wise, it's not down as much as the other ones, because it's so expensive to get in, it's actually taken a pretty big hit. I think I forgot to mention this, but the ZEEHBS cost us $22,936 to get into. So although percentage-wise, it's not as big as the others, dollar-wise, it's painful. So actually, to me, even though it's down the highest percentage, the winner here is the LEAPS option because dollar-wise, it's down the least. And I'd give a close second to the ZEEHBS, the one that has the hedge on it, because it actually held up okay. But in last place, we have the Zebra. But honestly, the ZEEHBS was pretty close to Zebra, so to me, the LEAPS is a clear winner here. All right, now let's fast forward several months to 190 days in trade. And I picked this spot because notice what happened. Although Tesla had gone way down in price, it now went way up in price. See, actually the stock at this point was up. So if you own the stock, you'd actually be winning at this point. So what happened to our 3 LEAPS strategies? Well, let's dig in and find out. First, we have our LEAPS call option. Remember, it cost us $6,300 to buy this call option. Well, now it was actually up, not much, 2.07%, but it was up by $131. But remember, if you own the stock, you actually be up pretty good because the stock was trading at $266. So our LEAPS call option, it's okay. It's not up nearly as much as the stock is, but overall, we do have a win here. What about our Zebra? Remember Zebra, it tried to take all the extrinsic value out of the position so that the stock went up and Delta was already about 100. We should go up almost dollar for dollar. Well, how did our Zebra position hold up? Well, it actually did pretty good. It was up 7.45% or $888. So dollar-wise and percentage-wise, it definitely is beating the LEAPS call option at this point. And Zebra, well, it's doing okay. It's up $355. But remember, this position costs us a lot more. It costs us almost $23,000 to enter. But it was up at this point, so that I'd say is a positive. So which is the winner? Well, at this point, with the stock being up like it is, I'd say Zebra is the winner here. That high delta really helped it out. So Zebra won in this scenario. Now remember, overall, we're looking at a bunch of different scenarios when the stock is up or down because we want to find out overall what is the best option trade to do when the market's up, down, whatever. Which one is the best? But in this scenario, with the stock being up, at this point, Zebra looks good. Just remember, it was about twice the cost of the LEAPS option. So kind of keep that up in your mind. Now let's fast forward to 216 days in trade. So about a month after the position we just looked at. Now what's happened is the stock topped out and has come way down again. How do our positions fare now? First, our LEAPS option. Notice it's down $4,200. So not looking great. It's back to a loss of about 67% of our original $6,300 capital. And how's our Zebra doing? Well, it's down about 50%. It's showing a loss of $6,000. So pretty big hit there on Zebra. And what about ZEEHBS with that nice hedge? How's that doing? Well, it's actually down $6,500. So dollar-wise, it's down quite a bit. Now, it's only 27% of how much it cost us. But remember, it cost us a whole lot of money. It's about $23,000. But it's taking a hit. It's down $6,300. So honestly, I don't really like that. So you tell me what you think. Where are we at so far? Do you think LEAPS, Zebra, or ZEEHBS? At the 216-day mark, with the stock now being down, in my opinion, the LEAPS call option wins this spot. We're gonna look at 2 more time frames before I give you my final decision here. I want you to see the stock move up and down throughout time. I want a time to pass so you can see how that time decay ate away at the value of the LEAPS call option. But I also want to show you some highs and lows throughout the time frame of this trade to help you see how all 3 of the strategies perform. We're now 295 days in trade. We'll look at the final time frame at the end of this trade in just a minute. So where are we at? Here we see Tesla, it's down. It's down from its original position. Now the line here, the dotted line here, it's down from its original position. It's now trading at $213 per share. How's our LEAPS call doing? Well, not so great. It's down $4,700 of the original $6,300 that we spent. It's down 75%. And what about our Zebra? Well, it's down $5,700. So more than our LEAPS call option. So that honestly isn't looking all that great to me. What about you? What do you think? And now our ZEEHBS. Remember, our ZEEHBS has that protection, that protective put. How's that holding up? Notice it's down $7,100. So actually, even though it has that protection, it just hasn't kicked in yet. So it really isn't paying off. I'm beginning to think this protection, it's only gonna pay off if the stock were to go way down in price. So based on all this, the winner to me at the 295 days in trade mark is the LEAPS option. It not only cost us the least, but we also have lost the least. Now let's move forward to expiration. Where are we at right at expiration? First, let's run the numbers on our stock. Remember, Tesla was trading at $247 when we started this overall position about a year earlier. And the day we closed it out, it was trading for around $391. That means there was a profit of around $144 per share for Tesla. So if you own 100 shares, you'd be up about $14,400. But keep in mind, you would have to spend $24,700 to be up that amount. Well, how do our 3 option trading strategies end up in this position? Let's start with our LEAPS call option. Notice our LEAPS call option is up 155% or $9,818. That's a really nice gain. We only had to spend $6,300 to get that gain. What about our Zebra? How did it fare? Did it beat our LEAPS call option? Remember, we spent $6,300 here on the LEAPS and we made $9,800. Well, it did make more money. It made $14,180 profit. But remember, it cost about twice as much as our LEAPS option, and it was up 118%. So overall, it did pretty good. It did what it was supposed to do. It got rid of the extrinsic value and experienced a nice gain over this time frame. And then finally, what about our ZEEHBS, the one that has the protection? How did it end up? Well, it had a nice big dollar gain. Remember, it cost us about $23,000 to get into it, and it was up $15,000. But percentage-wise, so-so. It was up about the same as the stock, about 65%. So overall, it did pretty good. But remember, we had $23,000 we had to spend in this position, whereas our LEAPS call option, we spent less than $6,500 on it. So what are your thoughts? Which one do you think is the winner? Should you own the stock? Should you buy a LEAPS call option? Should you do a Zebra that gets rid of that extrinsic value? Or should you do a ZEEHBS that gives you some downside protection in case there's a big move against your position? What do you think? Go ahead. Hit pause, and I'll share with you what I think after you get done responding. Let me give you a couple of thoughts I have on comparing stock against LEAPS options, against Zebras, against ZEEHBS. Or in other words, what did I learn or what was reinforced to me in doing this big back test? First, if it's a non-dividend paying stock, you're gonna own at least 100 shares. In my opinion, why would you buy the stock? You just do one of these different types of option trades, have a lot less at risk, and pretty much get the same benefit. I mean, you could have bought a LEAPS call option that was so deep in the money that it acted just like the stock, as delta was also around 100 for the whole position. That was one thought that was reinforced to me is, why own non-dividend paying stocks if you're gonna own at least 100 shares of them? you're better off just buying a LEAPS call option or doing a zebra or doing a ZEEHBS. The other thing about the LEAPS call option in all three of these strategies is that if the stock were to really tank, like go way down in price, they actually give you some protection. Whereas if you own the shares and it went to zero, well, you had a lot bigger loss for that same 100 share position size. So to me, these option positions win out, especially on a non-dividend paying stock when there's no dividend to collect. The second thing that really stood out to me, and honestly it kind of surprised me, is that the LEAPS call option by itself is a lot less expensive. It actually held up pretty good during those dark and gloomy times when the stock crashed. That hedge that the ZEEHBS had, it really didn't do a whole lot. It did help it percentage-wise, but dollar-wise, you had to spend so much money on the same position to get the same benefit the stock went up, that to me, it really wasn't worth buying that hedge. I'd prefer to come out of pocket less, buy the LEAPS call option instead of buying that ZEEHBS that had a hedge in it, but really didn't work that great. Now, if the stock had gone way down, it might have kicked in, but honestly, we had so much less at risk in the LEAPS call option that to me, ZEEHBS kind of fell on its face. So out of those two, ZEEHBS and the LEAPS call, I like the LEAPS call hands down. But what about the LEAPS versus the zebra position? Now overall with the zebra, if it's a very strong bullish market, I think the zebra is actually the way to go. That Delta 100 right off the top with no extrinsic value, well, that's just gonna perform really well. But you kind of got to feel really strong that it is going to be in a very strong bull market. And the LEAPS did well too, but not quite as well as the zebra. But now think about this overall back test with the highs and lows of Tesla moving all over the place and really looking at the dollar figures that the position was up or down. When I compare those against each other, to me, there's a pretty clear winner. Now, hopefully you voiced your thoughts in the comment section below because I'm about to share mine. To me, the winner is clear and simple. It's the easiest one to do with the least commissions, and that's the LEAPS call or put option, depending on if you're bullish or bearish. I like the low cost. I like how it acted throughout the trade. Of course, when the trade was down, it was down a lot percentage-wise, but we also had less at risk. So dollar-wise, I like how it acted better. And in the end, with Tesla being up, it did really well. We would have had a really nice win. If you haven't responded already, let me know which one you think was the winner. Which one would you use? Or which ones do you use? And how have they performed for you? Let me know down in the comment section below. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. LEAPS options, whether it's a zebra, a ZEEHBS, or a LEAPS call or put, is an option trading strategy that every trader should know. If you'd like to learn more about LEAPS options and how I use them in option and stock trading, check out the video series at the link above and the description below entitled Poor Man's Covered Calls and LEAPS Options. Until next time, happy investing, and we'll see you again soon.